sure. Let's get down into business. So
Yeah.
last we spoke was, I believe, the 23rd.
Okay.
S&Ps went out the day around 4,700. Okay. Now Santa shows up, right? And Santa week, we're in the midst of it right now. We're about to conclude Santa rally week, and S&Ps went from a close of 47.15, where they sit right now, 47.90. That is oh my gosh, Frank, 75 points higher, which is roughly 1.5% in the S&P 500, almost 2% in the S&P 500. And what I showed is since 2000, on Santa Rally Week, the S&P 500 on average moves higher by 0.8%, 0.8%. And so Santa was very kind this year to the stock market. Or is this an opportunity to sell, Errol?
That's what I'm thinking. Personally, I'm looking for maybe opportunities to get a little short, just for more of the short term, just to see if we do get that. And then if we don't, then I'll position myself correctly. I won't be sized in too large. But yeah, from the Santa rally, I thought maybe we get a pullback at least after such an aggressive move up for it to be even healthy, in my opinion.
For sure. And so here's the deal. Here's how we take data in this context. Is we look at the last 20 years. It says that on this week, the stock market outperforms by, 0.7% on average, what it usually does. That's what the data shows us. And so then we say, okay, if the market just kind of goes higher by 0.5% to 1 percentage point, there's nothing to do, right? It's like, oh, this falls in line with what the data says and what we were expecting here relative to almost more data than Errol has days in his life. And It was a lot of data that went towards this. But now that we have a stock market that is up double that expectation, and we're nearing the end of Santa Rally Week, I do agree with you that there is some opportunity to get short. Now, what you want to do, especially, the markets are open tomorrow. You and I will be working tomorrow and in front of our stuff. But a lot of people, given the New Year celebration and everything else, will not. So you want to make sure you have stuff on that isn't going to be scary when you show up to your platform in 2022, right? Mm-hmm. So we don't want to be selling E-mini S&Ps. This thing is freaking huge. Look at that. 16 grand. I don't have 16 grand to get short the stock market, Errol. Yeah,
no, that's a large position size.
And if this market moves even 0.5% against us, say it moves, 20, 30 points in the S&P 500, that's, 500,000, $1,000 to $1,500 there against that. That'd be a normal activity over the weekend here. That's a lot of money to go against us. So we want to make it smaller. We can at least go to the micro S&Ps, but that market still $1,600. And if the market moves against us a 0.5 percentage point to 1%, like I'm saying, 20, 30, 40 points, that's still going to be, $200.
Yeah, you still feel it.
Absolutely. And so what I would caution people towards, I do agree with you. The opportunity is there. I would go to the small stocks market. I know we are here talking about the small exchange and everything else. You can see it's right there at those highs. It had the big rally on Monday, similar to the S&P 500. And what's nice here is that it's going to be a smaller trade. A percentage higher in this market is going to be more like $80 as opposed to a couple hundred in the micros. What's that?
So how would you approach this time around the end of the year? You're showing us what kind of products we might want to look for depending on what kind of risk we want to take on, but how would you approach this?
I would approach this like it's pretty much any other weekend. And it's nice because the segment that we're doing today is about weekend risk. Because I thought, people probably have some stuff going on into this weekend and maybe worried about the new year, or maybe you're traveling over the new year, or you're just not in front of your platforms tomorrow or Monday or what have you. And what's really nice though, Errol, is that I don't approach it almost any differently. It's first of all, in terms of the new year, it's another weekend, everybody. I'm not worried about my futures unless there's an expiration week approaching. There's no expiration here at the end of the year. So you're all good. I mean, I can feel confident getting short this stock market here, as long as I'm comfortable selling into this rally and holding the position for the next couple of days. I have really nothing holding me back from getting short here. And I've got the smaller product on. And so, like I say, my risk is diminished a little bit here. And I'm treating this end of the year or the weekend just like any other. Now, that being said, what I like is further downsizing the risk here and actually buying some yields against it. Yields highly correlated with the stock market. And of course, you could just sell that Santa rally like we talked about. Almost double what the market usually does on this week of the year. But I don't mind getting short the stock market and buying some of these yield markets that are moving lower and usually move up and down with the stock market. But you can do one or the other or both, whatever it fits your account, your fancy.
So have you ever done any studies on adding to your position? Maybe you have one contract and then maybe you get a move that you want and you add another contract to move your average. Have you done stuff like that before? Like, let's say over the weekend, you get the move you're looking for. Now you want to get a little more aggressive or what have you.
I mean, so yeah, that is great question. Great way of thinking. I mean, it's the way that I think about almost all of this stuff because it is statistically based, right? Like we talk about standard deviations all the time. We talk about price extremes. And I mean, even the Santa rally conversation that we led the show here with is the idea of like, we're expecting X and actually now we saw 2X. And so now I want to get on the other side of that outlier. If we saw 3X, then yeah, I'd probably add a little bit. The key is when you're price averaging or scaling or whatever you want to call it, is starting small and making sure from the outset, saying to yourself, how many of these do I want to have on at any point? If the answer is 1, then you're not scaling. That's the end of it. If the answer is like, oh, I could see myself selling 2 or 3 of these, then start small, sell 1 at 2X the Santa rally, and then look at selling 2 or even another 2 at 3X that Santa rally. If it gets there, if it doesn't get there, obviously you're probably in the green. The market has kind of come back in your favor. But yeah, that's a great balance of a lot of the statistical work that we do on this show is like when the market is up or down 1 standard deviation, I'm getting on a little bit of my size. If it's up or down 2 or 3 standard deviations, that's when I'm starting to kind of ramp up to almost all of my size. And then from there, it's a matter of management for profit or loss.
So one more quick question for you.
Yeah.
So depending on how aggressive you go in a position, are you going to help determine this for yourself by the standard deviation, depending how convicted you might feel? Or let's say we get a 1 standard deviation move or a 2 standard deviation move, and you can also throw in a more specific event like the Santa Claus rally on top of those standard deviation moves. Does that make sense?
100. I mean, the Santa Claus rally thing to me is just like an example of these data points. Like it's no different than how standard deviations function in just everyday day trading, which is to say, yes, you're exactly right. Like when I see a market that, and you scroll all of these markets and you see stuff, almost everything is inside even 1 standard deviation, especially here in equities. I mean, everything is basically unchanged. Even in crypto today, everything unchanged. Now, what you see here is, okay, the euro, that's down a pretty good chunk. The standard deviation in the euro, and you probably don't have this data, but just trust me on this. I look at this stuff a ton. The euro standard deviation is around like 40 points. It's down 35. Okay, that's decent. I would maybe dabble in something like that. Gold and silver, kind of similar. It's like, oh, it's up almost a standard deviation. I maybe dabble in some shorts there. But then you get to something like natural gas. This market is down probably a full standard deviation and then some. This is something where it's like, I feel more confident about this because it's at a greater extreme relative to the data. It's something you and I get back to a lot of times, which is like, the data does all of my decision making for me here. It's not like a matter of, if everything was down one standard deviation, it wouldn't be like, ooh, I got a hunch on that one. It's these are down one standard deviation, these are down two standard deviations. I'm going to buy a little bit of this, but I feel better about buying some of this stuff. That's actually a good segue into, you look at soybeans today. Getting hammered. This is probably the biggest outlier move of them all. This is something that I would feel even more confident about than probably buying natural gas, which is, it's down a considerable amount, but it's probably down like one standard deviation. Soybeans here down for the winter time. They're usually seasonally volatile in the summer. This is a big move to the downside. But yeah, those data points do affect my confidence, Errol, to answer your question.
So, and are there binary events that take place that will make you more convicted? Like, again, we'll still get that outside move, but this time it happened to be because of this binary event. And because of this event, maybe you track statistics, how many times it's happened a year, and you have a bias for one side or the other.
Yeah,
still taking into account those data points.
I've done a fair amount of research on exactly that. And what we find is on days when there are events that are relevant to a given market, okay, like earnings for single stocks, right? Or when the Fed has a meeting, the Federal Reserve has a meeting, that with interest rates, or when OPEC, they have a meeting about crude oil production, and that with crude oil and other commodities that are maybe byproduct of crude oil. Those days, Errol, if anything, I'm less convicted. I'm less confident. Because here's the deal. On those days, the data shows the ranges are wider. And so if I have a market X, Errol, that is priced at $100 and it has a one standard deviation daily range of $1, that means it's priced at 100. Every given day, it moves about $1. If it's a random day, there's nothing on the docket for market X, and the market is down $2, I'm looking to buy it, and I'm feeling pretty darn good about it. Okay.
Okay. Continue.
And
I don't want to jump in.
No, you jump in whenever, man. As you can see, I've got too many words, and you need to cut me off to get anything in. But if market X is at 100, standard deviation on a daily basis is $1. Market X is down 2, and market X today's earnings, I'm not buying that.
Yes, that's exactly what I was getting at. That is exactly what I was getting at. It's like an extra variable. The binary event is the extra variable that can mean something a little different. And I was wondering if it meant something different to you, how you approach that. Like soybeans is down today. What if that was down because of some release that happened earlier today? Are you thinking different?
It's a touchy thing, because I first of all, I am probably least knowledgeable about the structure of the agriculture asset class than I am about the structure of any other asset class, which also, on the flip side of that, you don't need to necessarily be a farmer to trade agriculture, in the same way that you don't need to be a Fed governor to trade interest rates or any of these other things. But I do give that caveat of, like, I don't know when WASDE reports are most of the time, or when there's inventory reports on some of these ags. So there very well might be a report on ags here today, but I know that number it was down just a second ago, 35 cents. Now it's only down 31 cents, coming back a little bit here. That number's big, report or otherwise. And the slippery slope, Errol, becomes if you confuse yourself with all, like, earnings for a stock, that's relevant because it happens 4 times a year. And there's considerable amounts of data that say, hey, on any given day, Amazon moves X. On earnings day, Amazon's likely to move 2 or 3X. So that's something you need to be aware of. But some of these markets, especially ags and energies, the commodity markets, they have inventory reports on a weekly basis, some of them twice a week. And so when you have that many data releases, you kind of throw that stuff out, because at that point, it's like, it's not moving this stuff by that much. You're cognizant of it, but don't let it scare you off. But yeah, earnings, Fed meetings that happen only 10 times a year, those things definitely, it's a scenario where market X at 100, daily standard deviation of 1. If it has an event that only happens a handful of times every year. I'm just making that number, 2 or 3 times that before I get into a market. The key scenario for trading futures, day trading especially, you want there to be no new information. Okay. You don't want anything new happening, because you just want markets like, why is that thing up today? Oh, no one really knows why it's up today. Okay, I'm selling it. That's what we want to do here, right?
Mm-hmm. Yeah, no, I like that. I think you took that to a really great point there. But that's one thing I just really had in my head when it came down to finding these outlier moves. Are you just straight finding your opinion or bias just straight from the numbers? We get an outside move today. I feel comfortable selling this. No new information, and that's that. Just another drop in the bucket. This trade isn't more important than the other, and you're just kind of trading it like that.
Exactly right. Okay. Yeah, you have to be aware of what's going on in these markets. Like Tom Sosnoff is the furthest like what I just laid out. Tom Sosnoff is that, but even on steroids, where he's like, even when the Fed says something, I don't care. All of it doesn't matter. You have to, like, earnings and some of this stuff do matter. These markets do trend in directions, especially when there's fundamental changes to those asset classes. But I do agree with Tom wholeheartedly that it's like a lot of this stuff, people in the moment are like, oh, this is going to change the landscape of interest rates and everything else is going to change. 9 times out of 10, stuff doesn't change. And we just get on the other side of these moves because it's like, man, that's a wacky move. Why is that thing doing that? Oh, nothing's really changed in that market. Yeah. All right, I'm going to buy it or I'm going to sell it.
Now for you, when you're putting on a position to not get shaken out as to why you probably don't care about a lot of this outside noise, first of all, is there a specific, how are you managing your risk? Because I know with Tom and stuff, it's always options. We're managing around 21 days. We're either going to roll, we're going to collect more credit, whatever it is. But for the futures contracts, how are you going to manage that?
Even simpler. Like, first of all, we're day trading a lot of times. So like, I'm usually not trying to hit the pillow with any of these positions on. Okay. And so like the end of the day will take me out a lot of this stuff. But also in the same lens of those standard deviations in that data that we use for our decision making, it also factors into the decision making on the back end too, which is management. And so like the last thing you want to do is see a big move in soybeans. Buy soybeans down at 1337. Okay. Because the market is out 1 standard deviation and you're like, well, man, this is wacky. This is weird. I'm going to buy this market here. And maybe let's just say for the sake of argument, the standard deviation on a daily basis in soybeans is 20 points. Let's just say that. Okay. The market's down 30 and I'm buying. If the market gets down 40, maybe I wanted to scale into 2 or 3 units. Okay, market's down 40 now. Maybe I'll buy my second unit. But if that market gets down 50 or 60, I'm looking to take out this thing off for just as much as I was looking to take out of it in profits, because the last thing I want is a soybean position tomorrow or next week or next month when I wanted to day trade soybeans on a 30-point down move on December 30th, whatever freaking day it is here. You don't want these things to start to permeate your portfolio for extended stays. That's why they call it day trading. That's why futures have so much great opportunity in short-term trades. I understand options. There's a lot of defensive mechanics and you can roll this thing out for a credit and you can, sell the call against a put that's underwater and everything else. In futures, it's a simpler game. Okay. The market's down 1 standard deviation. So I know I have some edge in my favor, which is the stats say the market should stay within that range 68% of the time. So I got 68% in my favor if I buy this thing down a standard deviation. I need that probability, Errol, to play out in the long term. I'm trying to trade soybeans hopefully every day.
You'll take this trade 100 times and hope to have that edge over 100 trades.
But the 32 of them, Errol, can't be trades that I'm nursing weeks into the future or that I'm taking, 30-point losses when on my 68 winners, I took 10-point gains. You can't do that.
Now, so this is like risk reward. Do you measure reward by R multiples? So like I'll risk 1R to make 2R. And then I see exactly what you're saying because you want to end up profitable. So it's almost like what's your risk reward with your win percentage kind of thing attached to it. It's like you can even have of win percent under 50%, depending on what your R is at the end of the day.
That's exactly right, Errol. Now here's the thing. Okay. I'm not a simple man. Okay. I like the finer things in life. I love good music. I love going out and having some good food and some very complex stuff. When it comes to trading and day trading futures, I'm as simple as it gets. It's 1-to-1, baby. Okay. I've got the edge in my favor on a percentage basis. I've got the edge in my favor on that percentage basis. I'm trying to trade multiple markets every day, and I'm trying to trade every day. I'm going to be here tomorrow. Okay. Tomorrow's December 31st. A lot of people are off, doing whatever for the end of the year. Frank's going to be here tomorrow. He's going to be looking to trade. And since I have that edge in my favor, I am looking to just win as much money as I lose and vice versa. It's very simple. It allows me to make decisions very quickly. It allows me to make a lot of decisions. Exactly right. Like I buy this market down 30 and I know that the standard deviation is, like we say, 20 points. It's down 30. I'm going to try to make half a standard deviation. So I'm going to try to make 10 points. If the market gets down 10, I'm out. Now, if I was going to, like we say, if I was going to scale, so it's down 30, I buy one. It's down 40, I buy another one. It's down 50, I buy the third, and I'm only doing 3. Then I'm cost averaged at 40. But if the market gets down, more than 50 or whatever I was trying to take out of it from there, then I'm taking my contracts off, and it gets a little more complicated there. But just start simple, everybody. If you're trying to get into futures in 2022, start with a small futures contract like we have here at the Smalls. This is where Errol started, right here in the smallest one.
Oh, it was the 2 year, yeah.
It's as small as it gets. It's a $700 contract. It costs you $170 to trade. It's down around 1 standard deviation today. Not really. It's not a ton of opportunity, but start small here. Look for, this is a big move to the downside. I'm buying it and I'm looking to flip it for 10 or $20, and just don't let it get out of hand. And then you slowly get more comfortable. Oh, now I'm trading a couple times a week. Oh, now I'm trading a couple times a day, and I've got plenty of opportunity, especially when volatility spikes. Volatility spikes for almost all these asset classes. Then you have a lot of occurrences, a lot of trades, and that 68% is working in your favor in the long term past, 10 trades, 100 trades, hopefully up to even more than that.
No, I like that. So for you, when it comes down to a game plan, when you come into market open, you're checking your watch list and you're just looking for moves that have those outlier moves. If there is none, are you just sitting on your hands?
Yeah, it's a tough thing to do, but you have to have that patience. You can be a contrarian or a trend follower or what have you, really do anything that you want. But don't cross yourself up, right? Like the last thing you want to do is like, it's a slow day. Everything's inside. Now I'm going to become a different kind of trader. Yeah, you do have to sit on your hands sometimes. But what's really great about Tastyworks, about Small Exchange, about just modern technology and how it has met financial markets is you have 6, 7 asset classes at your disposal. An asset class just grew out of people's computers in the last couple of years. And so I'll be damned if there isn't a day where there's something to do. Today, it was I can't believe we actually just ran through the whole show here. We'll have to save our segment on weekend risk for next time. But today it was soybeans, and you've got all these markets at your disposal. Soybeans and natural gas is what we looked at here today. Now, they're not headliners. They're not stuff that you're talking about over the weekend most times with your friends and family, but you've got access to them. You can try to stay small in them and try them out. And you've got opportunity on your watch list almost every day of the year, I think.
Yeah, I like it. One last quick question before we head off, Frank. Will you look at the larger picture, and I mean like looking at the daily chart rather than the intraday, to get an opinion on a stock? Meaning if we have a large move to the upside or downside, are you just going to put a position on because the data tells you to, or are you going to zoom out? Let me look big picture. Yeah, we're down today, but we're actually at all-time highs.
I would say that's probably something that humans and myself especially are probably pretty bad at, which is they do this. And I probably shouldn't. Actually, I've shown data for crude oil which has told me that on a daily basis, the likelihood of crude oil moving higher or lower is almost exactly the same, whether crude oil was below $25, between 25 and 50, between 50 and 75, or above $75. I sectioned it off into those ranges and showed, man, this market it's not more likely that it moves up or down in any of those ranges. So the answer is yes, I do factor those things in. Like you look at natural gas, market's been beat to hell the last couple of months here, and it's down today. And so you might say to yourself, oh, I feel more confident about buying this market that's beat up in the long term and beat up in the short term. But you probably shouldn't, especially if you're trying to just like really get into day trading and trying to be kind of a purist about it. Probably shouldn't.
Okay. And your reasoning again for that?
Just the data has shown that like no matter where the market is, if a market is up on the year, it's down on the year, it's flat on the year, the likelihood of it moving higher or lower, it's memoryless, right? Like I don't know, in math theory, this is always a big topic that people like to do research on, which is kind of interesting, which is like memorylessness of markets. The market doesn't really know what it did yesterday. Like, right? Like the market's going to randomly move and we put standard deviations on it and we trade that random movement in accordance with data and statistical edge. But the market doesn't really have a memory for what it did yesterday, last week, last year, or what have you. So you got to let that stuff kind of slip by the wayside and not factor into your day trades in the moment.
Interesting. Last quick thing. What are your thoughts on game theory?
Yeah, sure. I mean, all this stuff is like interesting.
Like, have you gotten like curious about it and just applying it to the stock market? Have you been curious and researched it on your own, game theory?
Sure. I think that it's applicable. Like all of this stuff is applicable, whether it's memorylessness, game theory, all math is super sick. And there's so much stuff that applies to decision-making in markets. And I'm sure as you're seeing, as you research more and more of this stuff, decision-making just in everyday life. Like it's weird and it feels like robotic, but the best decision-making oftentimes has to do with just using probabilities, using data, using numbers, and getting your emotions out of this stuff. That being said, like I would say, don't go too deep. Like if you have some good foundational pieces of mathematics and math theory and statistics, like to me, I've gone into the deep end of the pool on a lot of this stuff, but it always comes back to like, just stick with your standard deviations, stick with volatility. If you're an options trader, the further you go at some point, you're not like a supercomputer who's like finding something that everyone else isn't seeing. Like I've got a watch list here of 20, 30 symbols, and I've got in my head the standard deviations on all of them. And that's pretty much all I need. Like, it's not like if I go deeper on math theory, I'm going to find something that Errol doesn't see here. Right. So it's interesting stuff. It's great to research. At some point, it does become relatively useless. If you've already create your foundations, create your strategy for yourself, and then just apply it over and over.
I like it. It was a really good session actually for today. It went kind of quick.
I love this, that, like I put together a slide deck around weekend risk, and between you and me, I'm just going to use it tomorrow with Mikey G. But I love that, Errol, you can tell everybody at home, I'm sure, and I can definitely tell, you're into this stuff, man. You're getting really deep here on day trading and everything else.
Yeah, no, it's really intriguing. And you just had some experience. So it's like, well, what was your experience? Because I'm sure you're trading around my age and had some of the exact same thoughts. So
you know what but it does feel kind of cold. I know Errol cares about me and actually does. He's interested in this stuff, but also interested in me as a human being. It does feel like have you ever heard of Harry Potter before?
Oh, of course.
Okay. Have you seen all of them?
I haven't. I haven't.
Have you seen the last ones?
No, I'm sorry.
Oh, no.
I'll actually watch them. It's just because growing up, I actually wasn't allowed to watch that stuff in the house. You know?
No, I don't care. You don't have to watch. I'm not going to jump on.
Oh, no. Like I'm saying like, that's why I never got to as a kid, but like I watched a piece. I just never found it that interesting, but I'm gonna get into it. I was Harry Potter for Halloween. So like,
oh, look at that. It's cool. It's cool. It's interesting. But one of the things, especially they get later in the series and the stuff gets kind of a little wackier. As you could imagine. And one of the things is the witches, they can, or wizards, I don't actually know what they call themselves technically, but they can like, they can hold up like their wands to your head and you can like take a memory out of someone's brain and you can like have that experience. And I do kind of feel that with Errol here, where he's like, all right, Frank's been around the block a few times. Yeah. He's got this information on futures. I'm just going to slowly take the things out of his brain.
Like, let me sharpen my learning curve by learning what you learned. So.
No, it makes sense, man. I don't want you to go have to read any books that I read that aren't relevant in my life. So just get the information where you can get it. But we have to run, Errol. Let's do this again next Thursday, the first time in 2022. Everybody join me and Errol every Thursday on Small Stakes. Join Errol every day, Monday through Friday on Today's Assignment. 2:00. Follow him on Twitter and TikTok. And I don't know if you follow people on TikTok, but just look for Errol. He's doing a bunch of cool stuff. Thanks as always for joining. Any parting words in 2021?
I'll see you next year.
Beautiful. Enough said. I'll see you in a couple minutes, everybody. Splash into Futures is coming up next. Stay tuned. Thanks for watching. Peace.